And we got a warning from Barron's over the weekend. Their cover story was titled, "Why the Bull Market Could End in 2020. That piece says that by 2020, stocks will have felt the effects of higher rates and tax cuts. Let's bring in Mark Avallone, Potomac Wealth Advisors president. And I want to note, Mark, that the cover, and I love Barron's, it said could end in 20. It doesn't say will end in 2020. Do you agree with the premise that this bull market maybe has a year of life left in it?
Well, I think from the standpoint of the tax cut impact rolling off, that's not going to be an annual event. So if we're looking at earnings growth year over year, this year is very strong. We're 25% up over the prior year. But if you look out the following, or in 2019, late in 2019 and 2020, you're going to need another catalyst. Now, global growth is strong, but with all this political instability, tariff talks and tweets, it becomes less certain. And I think that's what the article is focusing on.
Yeah, I mean, do you agree with the general premise, though? I mean, that just this bull market, by any measure, is historic in its length, in its time, in largely its breadth.
Well, yeah, and there's so much uncertainty. Look, we can't figure out what's going to go on week to week because we don't know what the headlines are. But if we continue to look at global growth, which the IMF says is 3.9% for this year, corporate earnings are up, the consumer is strong, debt is down, and the impact of the tax cuts helping both Main Street businesses and consumers. If we were able to focus on that, we're going to look at a strong 2018. The problem is we have this tariff and tweet talk, and that's TNT for the markets. Every time Trump tweets, another political leader has to stand their ground and retaliate, and you led the show talking about how we're being hit just this morning.
Yeah, and we want to be. It's not sweet talk; it's tweet talk. And I hear your certain point, and you wonder why, because this is a president, as we've noted, who loves to look at the stock market as a report card for him. But you mentioned all those great things. We're 2 days away from the birthday of America. We want to be optimistic, but everything you mentioned, Mark, is in the past. Do you worry about the future? Because we don't know what global growth is going to be if we engage in some multi-hundred billion or even trillion-dollar trade war.
Well, that is the risk. But I think that we have an election in November, and as these tariffs and these talks begin to have a negative effect on the market, we're going to see a president who carefully looks at the market. He uses it as a proxy, as a bragging pitch. So I think if we see the market being hit by his rhetoric, he will tone it down. And then if we can then focus on the fundamentals, I do think it's a good year. I think there's too many good things happening to the economy, and he is too politically savvy to talk his way or tweet his way into trouble.
But the one big thing that the president largely cannot control may be the biggest risk of all: higher interest rates and the Federal Reserve and inflation. There's nothing he can do about that, Mark.
Well, we've talked about Jerome Powell before. He is the most important person in Washington when it comes to that. We see a flattening of the yield curve. That's going to suppress what I think they can be able to do. You've got global rates over in Europe, political instability. All that is going to suppress what Jerome Powell wants to do here. And with this yield curve flattening, that is a negative potential for the market. And I don't see the Fed being as aggressive as they'd like to otherwise be.
Mark Avallone, Potomac Wealth Advisors. I think I added an extra syllable to your name on the intro, but you're welcome. So we try to do is add syllables. Everybody gets a little extra here.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.